Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands, April the 1st, 2016, and this is the Daily Report for Gold and Silver, our weekend review in which we combine this with trending markets to get a more detailed understanding of the breadth and scope of activities this week in the markets overall. And boy, we certainly saw that with the jobs report coming out today. We had a pretty strong sell-off in the precious metals markets, oil trading lower, equities markets moving higher, and the dollar, which had been under tremendous pressure, closing in essence unchanged on the day. We'll try to take a look at all those markets. Of course, we had two active markets in which we had trades, one in which we did get stopped out, that is our gold trade, one in which we still have going, which is our long S&P. We'll cover both of those on today's daily report. Absolutely no doubt, a pretty solid sell-off on gold that absolutely affected a trade that we had going. We got long gold roughly at 1238. Our stop was sitting under 1220. Market today came to a low, you can see that right here, of about 1210. So obviously it did knock us out at a loss of about $19 on the trade. Traders, I absolutely apologize for that, but in the nature of trading, there is going to be a percentage of winners and a percentage of losers, and we have to always look at each trade independently, but look at the totality of the trades and how that affects our bottom line. And when we consider what we have seen so far this year, again, this is a trade that we put on and lost $19, but as you can see, our first trade of the year, we made $3, $44 on our second, $112 on our third, a push on our fourth. Our fifth trade, we made about $37 on the trade. And then, of course, on this trade, we did lose about $19 on the trade. That being said, where do we think that this market is going to go? And what are we looking at? Well, quite obviously, we did not complete, as I had anticipated, that final C wave right here as the market came and genuinely hit a low of around 1206. That was the intraday low. If you recall from over the last couple of weeks, my basic target, or what I like to call my sweet spot, that I believed we could see this market go to, in essence, was a band between, call it 1205 and about 1195, right in this area. And that, of course, was based upon a fib retracement. One of the most critical is that 38% retracement, and that is a retracement of this, really the entire move that we saw, meaning from 1046 up to 1286. When we put in a secondary fib retracement, that's where we get the 1205 number from the onset of this wave 3 up to the top, we get a 38% retracement at 1205. And so that's where we actually got that particular price point. Now, with that in mind, and with this most recent sell-off, there is a distinct possibility that what we looked at as waves 1 and 5, I'm still labeling as a correct labeling. A, B, and C, though, we've got our A and our B. This could all be part and parcel of an A right here. If it's a longer extended A, that would be one way to look at this model. The other way to look at this model is keeping the A and B the same and looking at the potential that we're still caught in really our C wave. So we've got wave A, wave B, and a long, more procrastinated, extended C wave down. That is another way to look at the market. In either case, we are certainly going to take a serious look to see where this market wants to find some support. In terms of long-term damage, I still believe that we are on track to see this market break over 1300. We talked about that yesterday when we talked about some of the different areas that we are looking at, which go into the 13 and 1400 range over this next year. So I'm certainly optimistic and bullish. Longer term, short term, we could have a little bit more headwind over the next couple of weeks. Strong finish for U.S. equities on the first day of the second quarter of 2016, with the Dow Jones Industrial Average just closing below 18,000 at 17,792. Now, we do have an active trade right now. We are long the S&Ps. We'll cover that in detail right now when we pull up our full chart. But Standard & Poor's vis-a-vis the E-mini closed up over 12 points on the day at 2064. the low 2035, and the high 2067. So traders, solid move in U.S. equities markets. Also solid move in the Standard & Poor's 500. We're looking, of course, at the E-mini, up 0.66%, 2065, up 13 points on the day. Of course, we entered a long trade when we got in earlier this week at 2046. And we put that trade on earlier this week. One of the main factors that led us to trigger that trade was the fact that we were effectively trading above what I consider to be a really critical area in terms of the marketplace itself, which is a 23% retracement at 2043. So as it broke above that, and you can see this headwind that was occurring just prior to that, as it broke above this right here, we did go in and enter a trade from the long side. As I said, we're in at 2046. Our current stops are at 2020. We will look to move those stops up right at the beginning of the week. In terms of upside target, I still believe that we could see U.S. equities drift higher and drift to the record tops. Realize we're just shy of 18,000 now on the Dow Jones Industrial Average, and my basic target for this particular trade is twofold. In terms of the most optimistic area, that would be around 2100. And then we also have this top that comes in at around 2075. So that's an area we want to see if any resistance forms, and above that at 2080. And that's based upon this activity right in here. Other than that, after about 2080, it's clear sailing to 2100. Crude oil under dramatic pressure today, closing off about 4% on the day, 36.68 per barrel in terms of crude light. It has been under pressure this week, during which we have seen crude oil prices lose approximately 7% on the week. Now, this is a weekly candle. You can see this particular drawdown on the week itself. As you know, we have put a potential ceiling or cap roughly at the $40 per barrel range. But what is most interesting about this week's activity is the fact that we have seen a decoupling of oil prices and U.S. equity prices. And really, to illustrate that decoupling, what I have done is I have created a chart. You have crude oil prices on the top, and you have U.S. equities vis-a-vis the Standard & Poor's on the bottom. As you can see, when this market hit that bottom right in here, and this, of course, is the S&P, that being in February of this year, the market moves straight up. Same with oil. Oil hits bottom and moves straight up. There's certainly a high correlation between the two markets, but look at the last couple of weeks. Oil up last week, equities down last week. Oil down this week, equities up this week. So absolutely, over the last couple of weeks, there has been a decoupling between oil and U.S. equities. U.S. dollar under pressure for the better part of the last 4 weeks. Dramatic pressure this week, is going to close on the day, in essence, unchanged at 94.61. So when we look at the big picture, and that's what we're doing now by looking at a weekly chart of the dollar index, but when we look at the big picture, we can see that over the last 5 trading weeks, we have had 4 of those 5 really take this dollar down to lower ground, breaking below what I believe to be a pretty critical level at about 95.25. And when we look at the U.S. dollar and the euro dollar together, we've got the U.S. dollar up top, euro dollar on the bottom. You can see that really since the beginning of March, we have had a tremendous rise in the euro. And really since the beginning of March, we have had a tremendous fall in the dollar. It doesn't seem that this particular trend will change in any time soon. Traders, maintain your current long position in your Standard & Poor's 500 E-mini. We will look to raise that stop early next week. Once again, we were stopped out of our long gold trade. We'll take a look at that market on Monday to see if we believe there is going to be further weakness ahead in the precious metals markets. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you next week for another daily update and review in the gold forecast, as well as trending markets. Bye-bye.